Hello and welcome to Vox Markets. I am John Human and I'm joined today for our macro monthly by Singer's Jamie Constable. How are you doing, Jamie?
Great, thank you. Very good. Good to speak.
Yes, likewise. And well, I mean, it's an interesting day to be talking on because we just had the latest US consumer price index figures, and the markets are off to the races. Tell us about what's going on there.
Well, they certainly are. I mean, people who've probably seen me before know I've done quite a bit of work on this and was saying that the first month where you could potentially see the big fall in CPI to the downside would be the October data. And we've got the fall. Is it huge? Well, it's delta that matters in markets. Markets thought the headline rate would come down from 8.2 to 7.9. It's come down to 7.7, and the ex-food and energy has come down from 6.6 to 6.3 against a 6.5 expectation. Market has been absolutely obsessed with the Fed pivot. That's what the market's looking for. That's why the market is getting very excited this afternoon. When I came just to record this, NASDAQ was up 5%, bond yields were down 20 basis points in the States. So that's what the market's been looking for. I think what's interesting about that CPI number is that shelter, which is calculated in a slightly weird way in the States, it's about 30% plus of the 30% of the index. That is still about 60% of the gain. If we look at US house prices, they're falling now. It's mainly rents and shelter, but they're related obviously to house prices. So I think we can, hopefully, we've certainly got the top in US inflation, and it's now a question of how fast it falls.
I guess from an investor's point of view, I mean, the reason that they're also piling back into the markets today is, as you say, there are great hopes that the Fed is going to take its foot off the rate accelerator, as it were, and really start dialing back how far it goes and how quickly it goes with rate hikes. Do you think that this actually really does, give them enough of a shove to actually take their foot off the gas there?
Well, they've done 475s in a row now. I think the chance of them doing 75 next time has now gone. So next rate decision is December. I think potentially, it depends what comes out on the economic data between now and then, I think, but potentially do another 50. So that'll get us to 4.5. But that, I think, will be the top. I think you're there or thereabouts on US rates now. Of course, they've been a lot more aggressive than we've seen in UK and Europe. So I think that's what the market's looking at. You're there or thereabouts. What the second part of my thesis is that obviously everybody's been long dollar. What I think you will see now is the dollar will roll over quite quickly. I mean, sterling's up over 2% today on the back of this. You've got all these global macro funds who, long-only funds, it pales into insignificance against these guys. They've got trillions to manage. They've all been long dollar. What are they going to do by the end of the year? Well, they want long dollar on their portfolios. They're going to certainly reduce it. Flows move markets. I think the dollar comes off as well. And when we're looking back towards the UK and Europe, that's very good news because some of that money's got to flow somewhere, even into the pariah market of the UK.
And so we'll come on to that because there's been a lot of talk about how cheap the UK market is at the moment. We'll come on to that in a minute. Let's stick with the US. So you mentioned economic data to come and how that might sort of sway the Fed's thinking as over the next month or so. What are we looking for? Because the US economy has remained relatively strong, certainly compared to what we've seen over this side of the Atlantic. But there are sort of signs of weakness. You mentioned home costs falling. The housing market there is rolling over. It's looking pretty tough.
Well, yeah, you mean the house prices are falling now. Jobs is really interesting, the jobs market, but we always have to remember there's a lagging indicator. And we've also had the pandemic impact this time, which has massively distorted it. You've got the so-called great retirement or resignation or whatever you want to call it. But lots of people, the workforce has shrunk globally. So that, I think, is a bit of a lagging indicator. But I think the US economy is, because it's it's got its own internal economy, if you get what I mean. It actually can survive on its own, as it were. So I don't think you'll see the depths of the downturn there. And especially now, you're probably going to get Biden being hamstrung from doing anything more. What he might have done would have been more inflationary if they brought in more Democrat policies. So I do think that actually the US economy, it is weaker. And you are seeing things like 11,000 people being laid off by Meta. I mean, these are big numbers. But you've still got a lot of job vacancies out there as well. So yes, the economy is rolling over, but that's why the Fed has to stop on the rate rises. I mean, there's a lag. Whatever anyone says, they started raising rates in February, March, and they've raised them, it's not by percentage, it's a huge increase they've had. We need to see the impact of that now, and with rates and with inflation starting to come back, So what we need to watch, going back to the original question, wages are going to be key now, because the key, what we need to see now, we've had a big spike up in inflation, which is very different to the 70s where it was already high and then it went up higher. We've had a spike. They need to nip that in the bud with the interest rate rises so you don't get it going into wages. And that's what they will be looking at now. So the wage information, in the wage numbers will be key. And also the PCE number, which is the Fed's preferred inflation number. We need to keep an eye on that when that comes out.
Okay. This is all part of the sort of bad news is good narrative that investors have been clinging to. It's all very strange, showing it's sort of things feel backwards. But the stock market is not the economy. But we are seeing also some signs that certainly some of the successful companies, the big successful investments of the past decade, are also starting to feel the pinch, particularly tech. When you mentioned Meta, but they're not the only one that are making big cuts to their workforce. And we had some sort of slightly disappointing earnings figures from some big tech names last month, including Meta, but Alphabet as well wasn't great. Amazon wasn't great. All suggesting that there are some real sort of recessionary forces at play in the economy. Should we be worried about an earnings recession to come? All eyes are on the Fed right now, but actually, as we go forward, it's the reality of weakening earnings that we should be more worried about.
I think we've got to expect earnings downgrades coming forward because the economy is slowing. These tech names you're mentioning there, the particular part of that was advertising. Obviously, advertising is a big part of their earnings, online advertising. As the economy becomes more difficult, companies rein back on ad spend. So yes, the market kind of has moved down, prejudging that, trying to get ahead of those earnings downgrades that we're going to get. So the rate cycle is kind of arguably now is peaking out. We've now got the earnings downgrade cycle to come in, and the market's got to get its mind around that. So what does that mean? It means the market overall can actually recover, stabilize and recover, but the individual stock risk in terms of earnings downgrades is a lot higher because you come out with a profit warning, dependent on where your share price is, and maybe we'll come on to that in a minute, but depending what your rating is when you come out with a warning, you're going to get hit if you're on a high rating. I think the big difference now, and something I've been talking about from the beginning of this year, that 2022 is about one thing, and it's the end of free money. Free money has finished. There's a cost of capital for everything now. What does that mean? It means that you need to be profitable or get profitable quick. So I think you're going to be a massive differentiation now, and while we're talking about the States on NASDAQ, a massive differentiation between profitable companies and non-profitable companies. I think the non-profitable ones, the ones not moving towards profitability, they're going to languish because their cost of capital has gone up, exponentially, basically. Whereas if you're a profitable company, it's much better.
I mean, do you think with the end of cheap money, I've heard talk about a great moderation. So we've sort of seen excess in valuation, for both profitable and unprofitable companies. Do you think we are entering an era where there is going to be a much more restrained approach to how highly we value even these fast growing tech companies?
I hope so. I mean, I think what is happening is healthy. We need to. I mean, it's back to the future as you get back to the future, really, in that, when I started, it was 10 times for 10% growth, 20 times for 20% growth. And he didn't have many companies on 20 times.
No, peg ratio of 1.
Exactly. So do we return all the way to that? Maybe we do. And it depends how deep the recession goes, to be honest. And also, they always tend to be a bit more optimistic in the US and higher ratings in the US anyway. But I do think that we are returning to that kind of environment. I think you do want to see inflation you don't want inflation going to 0. 2 to 3 is fine. You want positive carry in the economy. That keeps things healthy. It makes it easier for companies. Running in deflation is a nightmare. So I think that yes, we will see ratings move down generally. We're not going back to, I remember when Spirax Sarco in the FTSE 100 was on 53 times, and it's the best company, one of the best companies in the world. 53 times PE, how can it ever justify that in terms of how it's going to grow? So yes, I do think what's happened, we will do that, but I think it's healthy for the market. I think a lot of these zombie companies, which have depressed returns for everybody, where they've just been running themselves for cash because they can, because their cost of debt's nothing, they're going to disappear. And of course, that's very sad for the people working for those businesses, but actually for the overall economy, it's a positive, because the winning companies come through. It's a bit Darwinism, I suppose, but the winning companies come through, but they're the ones that are creating the value and creating the wealth.
I mean, historically, that process has happened. Well, not here, not in the UK where we're sitting so much. It's it's much more of a US phenomenon, that the kind of the kind of world-changing tech investments that we see. I mean, the UK is in a tough old spot. I mean, let's sort of go back to sort of politics and economics for now. We had a very gloomy statement from the Bank of England this month on what we're likely to see in the economy over the next couple of years, accompanying a 75 basis point rate hike. Although sort of suggesting that the peak rate will be slightly lower than the market was pricing in. Do you think that Andrew Bailey's being unrealistic about how low that they can keep interest rates, and perhaps overly pessimistic, or was talking down the economy deliberately in terms of his sort of recessionary outlook?
I was quite, like you, for the sound of it, I was puzzled by these comments they came out with, to say the least. I mean, they came out with saying market rates are too high at 5.25, but actually the market wasn't predicting that. Short sterling futures were at 4.6. So, I mean, it kind of didn't meet. Straight away you went, well, what are you talking about? And to be fair, I think that maybe they'd used numbers a few weeks ago, but it's digital world now. You can update your numbers just by pressing a number. So anyway, to answer your question, I think they've got so far behind the curve. That's the problem. It was almost kicking and screaming to 75 basis points, I think. What will help, I think, looking forward, is if the dollar does roll over like it is and sterling rallies, well, that imported inflation, which you and I, maybe not you, I've been around a while, but imported inflation is a major problem in the UK. Now, with sterling rallying like it is, if it rallies, continues to rally like it is, that's going to take the pressure off from that point of view. So that will help them on that. The economy is obviously rolled over as well. The problem for UK and Europe on inflation, and obviously that should be what the Bank of England's prime is. Often you think it's not nowadays, because they seem to be trying to manage everything else at the same time, but is the gas price and energy, which is obviously driving inflation in Europe and the UK. That's now back quite a long way. It's about 3 times where it was before, rather than pre-Ukraine, rather than 10 times. So that is taking the pressure off a bit. But still, I mean, even now I saw the numbers they're talking about, the price cap for the consumer coming through in January, when they next announce in January, it'll still be a 40% rise rather than a 70% rise. So they've still got to battle that. So they do need to raise rates further. I think they'll do another 50 basis points in December to get to 3.5. It will then depend on what happens in terms of if we do start to see what's happening in the States with inflation coming off. Remember, we're over 10 in the UK, 10.1. So we need to see that come off. It might go higher in the UK. Maybe it does go to 4 or something like that. And that's going to make it very tough. But if you look at gilts, they're not predicting that at all. The 2-year gilt yields at 3. So it's very difficult, because for the UK and Europe, as I say, you've got this extraneous influence of Ukraine and how that's driven inflation. It's different for the States because they've got an internal economy. It's basically an internal economy. So we need to see that roll over. I don't think they'll raise them. They needed to raise them quicker earlier and they didn't. So now they've got themselves in a real corner now as to what they do next. So maybe they stop at 3.5. If inflation rolls over, maybe it goes to 4. But it's not going to 5, let's be honest. If it goes to 5, you won't have a UK economy.
No. I mean, we'll talk about the housing market in a minute. I mean, I was looking at Eurozone inflation rate, so it's 10.7. If we thought the UK was up there at 10.1, the Eurozone is struggling worse, and it seems to be even further behind the curve.
Yeah, well, especially over there as well, because they're suppressing the energy prices. Places like France, they're holding it down artificially. So you've even when we're doing a little bit, but they're doing an extreme amount. So it's hard to visually depress there, but I mean, let's be honest, EU is going to hit a pretty hard recession. They haven't had positive interest rates for God knows how long. They've now got them, and the ECB have woken up now, really, finally, and the pressure is on to push up rates. So, yeah, you're going to get quite a hard recession in Europe, I think. And probably in order of how hard the recession is, it's probably least in the US, in the middle in the UK, and I would think Europe could be, depending on what happens with Ukraine, of course, but could be quite deep indeed, because look at Germany, look at Italy and all those countries. It's going to be very, very tough for them because they're export markets. You know, you look at what's happening now with China, the reshoring, nearshoring, because of them maintaining the COVID zero policy, is just accelerating faster and faster now. We're seeing about companies that we cover, and they're just talking about companies knocking on the door. Can you supply me from Mexico? Can you supply me from Europe? No, it's going to cost you more. That's fine. I don't want to. I can't take the risk on China anymore.
Yeah, should we talk about China for a little bit? Because I mean, one of the worries is that this is, you know, the recessionary pressures are global, and as you say, China, you know, having been essentially a sort of the world supplier for many years, and in fact exporting, you know, deflation in a way, you know, making everything making everything, you know, a lot more cheaply than it can be made anywhere else. China's shutdown, you know, zero COVID policy has been massively problematic for anyone who sources from China or wants to sell into China.
Yeah,
and we saw. So we heard this month there was a rumor that started floating around that this zero COVID policy was coming to an end, and you know, obviously there was a lot of excitement about that, which they have since denied. It's all very confusing. I mean, what's your view on what's going on in China? This place, you know, it's so important and yet so problematic.
I think the problem you got in China, it all comes from the top, and obviously Xi wants to be, well, he is a dictator effectively now. The one problem the issue the Chinese Communist Party want to avoid is civil unrest, because then it's all over. Now, I think that's partly why they've got COVID zero at the moment, or zero COVID at the moment. In some of the cities now, you've got 20% on youth unemployment. That's a big issue, because that's what causes unrest. That's what causes trouble. So I think part of that is suppressing. They can suppress areas whenever they want to by doing that. But the biggest issue for China is that because they had the one-child policy, their population now is not growing. Obviously, they did the Industrial Revolution in a number of years rather than in decades. Now they're not growing the population. To grow from here is now actually very difficult for them. Wage rates have moved up. It's cheaper now to produce in Indonesia than it is in China. So people will do that rather than in China. Yeah,
Vietnam's been the other one that's a big beneficiary of this.
Big beneficiary. So those countries are really going, you know, they're the new Asian tigers, if you want to put it like that. So I think China has got itself into a really bad situation now. Geopolitically, that's probably bad news, because what do wounded animals do? They kick out. So Taiwan, and that, you know, a bit like Putin, I suppose. Would they go for Taiwan because of that? And that's kind of one of those left field risks again that's out there if they were to do that. So I think China now, I'm not positive on anything exposed to China really, because I think they've got themselves into a real vicious circle now, really, and that's what's happening. Really, from being the global supplier of choice, they're now, well, everyone's moving away from them. So now all they can do basically is what they need to do now as an economy, which they were trying to do, to be fair, is they need to have that, a bit like the US, they need to have the internal demand to buy the goods that they produce. But to do that, the population need to become wealthier to be able to do that. So they've very quickly gone from developing to almost like a fully developed, mature economy from that point of view. Obviously they're not, but that's where they've got to. So yeah, China is in a real tricky situation now.
It is, and one of the sectors that really sort of bounced when these rumours about the end of zero COVID came about was miners. It sort of felt like a bit of an old-fashioned response because once upon a time, China would import billions and millions of tons of metal, and that seems to be the thinking that they're going to do that again and go on another infrastructure splurge, and that doesn't seem very likely to me.
Well, it's like a Pavlovian response, isn't it? China's going to recover. We need to set. I look at this, I'm looking at the mining sector and parts of the mining sector in a different way, in that the one side effect of free money, and it's quite a perverse side effect, is that it didn't encourage investment because you didn't get the returns. You had those companies being run for cash. So no one was really incentivized to invest. Then in the commodities space, you had the super cycle, which they had a massive hangover from as they all invested. So then you had investors putting big pressure on the mining companies saying, no, you've got to run these companies properly now. We don't want you to overinvest. We want you to return cash. We want you to pay dividends. So you've now got to a situation where, and it's certainly been amplified by the end of the pandemic and turning the world back on, pushing the go buttons all at the same time, that you've got undersupply in the world. And then you attach to that the fact that we've got the electrification of the world to happen, because if we don't do it, well, it's going to get a bit blooming hot for everybody. So we've got that on top as well. If you look at copper and also, of course, all the rare earth metals and things like that, we need investment in those. And I think that's more the reason why I think it's a second order effect. People are getting the direction right, but for the wrong reason. It's not because China's turning back on that you want to do it. You're buying those because the world's turning back on, as it were. So the world's turned back on. If you're going to move to an electricity-driven world, there's nowhere near enough copper being produced at the moment. So the copper price, actually, I really like the copper price at the moment in terms of something to buy. I know it's not an equity or anything like that, but I look at that and think, well, hang on a minute, from here, why it's come off because of a downturn, global downturn, but we're going to need more and more and more and more copper. And then there's going to be infrastructure on the investment on the side of that in terms of producing all the different the pylons for the cables, whatever it might be. So you'll need iron ore and steel. So I think that's why I want to buy the commodity stocks, not because of China coming.
Yes. A massive infrastructure play, and a global infrastructure play. I mean, the West needs that infrastructure very much.
The West needs more. I mean,
more than anything.
Yeah.
I mean, let's go back to. I mean, actually, I was going to talk about energy. Let's stick with energy because one of the things that's been driving the market recently, that's the sector that has been performing well, is energy, oil and gas. And again, that's what does seem. Yeah, of course, we've realised because of Ukraine that we are very energy dependent, and that this is a competitive market for energy resources. But we are still at the beginning of, or in the middle of, a transition away from such commodities. And again, there does seem to be a bit of a mismatch between what's doing well and what people are buying at the moment, and where the world is heading.
Well, you've got this you're stuck between two things, aren't you? You're stuck, oil in particular, you're stuck between a cartel on one side who controls supply. And then on the other side, you've got it's supply and demand, isn't it? It's not in anyone's interest to invest in new oil exploration, bit different on gas to a degree, but it's not in anyone's interest to invest in that because they don't know how long they're going to have that, they're going to be able to use that production. How long are they going to run those? Or are they going to then get hit by a windfall tax by the government, which means you don't want to do it anyway? So I think it's supply and demand on oil and gas. We know there's a finite. We don't know where it is. Is it 5 years? Is it 10 years? Is it 20 years? We don't know when demand is really going to start tailing down. But we know it's going to happen at some stage. And that means that prices go up, don't they? So, and as you say, massively, the gas price more than the oil price, but the gas price has been massively influenced by what's happening in Ukraine. But gas will have to be part of the solution because we're not going to be able to build the battery storage. It's not the wind turbines or whatever, or solar. You need the storage as well. How do you go through the night? You need all of that as well. We're not going to be able to build that quick enough, so you need gas in the meantime. So that's what's happening there. Again, it's supply and demand, isn't it? At the end of the day. So on that basis, these stocks are still not, they're making super normal profits at the moment. They're throwing off loads of cash. They can pay big dividends. But at the same time, what they're trying to do is transform themselves into new economy companies. Again, at the end of the day, isn't it? Investing in solar, wind, whatever it might be, whether it's Shell or BP. They're the guys with the cash flow to be able to invest in that. So you need to incentivize them to do it, really, which to a degree you do, because of course investment is offsettable against your tax. So, that's why they do well.
Yeah, I mean, that sort of takes us neatly back to sort of the UK. We know that we need a lot of infrastructure. We know that that certainly on the energy side of things, we need new power stations, probably new nuclear. There's one proposed up the road from me, as well. But we as a nation, our finances are not in a good spot. We have we lost essentially one prime minister and chancellor because of not being able to spend as much as they wanted to. Our new prime minister and chancellor are rumoured to be, mulling over some really quite significant, tax increases and spending cuts. So, whilst we need this infrastructure, how's it going to get paid for, particularly here in the UK?
Yeah, let's just go to what the new. We got the autumn statement. You asked about things to look out for. So you got the autumn statement next week on the 17th. What the government, I think, are having to do, they're trying to compress a 5-year political election cycle into 2 years, because if they want to get re-elected, they need to get the economy up and down and up within the next 2 years. So the bottom line on that is, what do you do as a politician? You get all the bad news out first, don't you? So we're being super loaded with bad news now, and I imagine that then it will come out and it's not quite as bad, whatever. But they're going to load in everything, all the increases, everything they're going to have to do.
So it's a proper kitchen sinks profit warning style approach then.
Yeah, totally. Get all the bad news out, and the hope that when we come to the end of next year into 2024, and I think they have to have the election by Q4 2024, they can start cutting interest rates, can start coming down again, and they can say, "Won't be clever, blah blah blah." Well, let's be honest, the electorate, we don't want to get into politics, but the electorate, it's probably not quite long enough time for the electorate to forget what happened. But anyway, by the by, so that's what they're doing. They're loading it up. What they're trying to do is to get the UK as an attractive place for inward investment. Let's be honest, we've done the turmoil we had made it an extremely, we were the pariah and we became pariah squared, if that's possible. But anyway, so what they're trying to do is make an attractive place for investment again, so we can get that inward investment, because people like doing infrastructure, particular. Look at Macquarie, look at all those. They've invested huge amounts in the UK. We need to get them confident enough to put money back in. Government should basically front load, do the initial investment, and then you get everybody else following in. But to do that, you need a long-term plan, and that's what I'm hoping, that someone finally comes out in government and comes out with a plan of where we want to be in 30, 40 years' time, rather than where we want to be in 5 years' time, so we get re-elected. That's what we need, and hopefully that's something that will come out of all the turmoil we've had, because then we can put the infrastructure in, whether it's housing, whether it's energy, whether it's road, rail, whatever it might be, and get the economy as an attractive place for people to come and invest in.
And one of the big complaints about the UK's economic performance over quite a long time now has been productivity. Presumably, we need these infrastructure investments to solve that problem as well. They must be related.
Yeah, productivity is all the really difficult ones. As an economist, the economist is training, and how the hell you measure it. I mean, it's always how the hell do you measure productivity? I mean, people argue that work from home made people more productive. But then, is it just that they're working longer hours? And no one really, it's really hard to put your finger on it. But the bottom line is, yes, we need to get more productive. And to do that, you need to be more efficient. What makes you more efficient is investment. And you see that in the successful economies. Where you invest, you have higher productivity, higher returns, and it becomes not self-perpetuating, but becomes a virtuous circle, doesn't it, really?
Yeah. Yeah. You mentioned housing. Now we are seeing, we've seen some horrible numbers from the US. We're starting to see some horrible numbers here as well, after what has been a very strong period for the housing market. Really, really very strong results, in recent periods from the house builders in the UK, but that seems to be hitting. They seem to be hitting the buffers now. Can you give us a sort of quick view of the housing market and what the implications of that are? Because obviously, my understanding that you know that the halo effect of housing is all important for the UK economy.
Housing is very important for consumer confidence and everything and all of that, because what is it? Englishman's home is castle and all that, and it's whatever anyone says, it's true, and that's what people want to own their own houses. So the turmoil we just talked about with trustonomics or whatever you want to call it and all of that
it's very generous to call it any sort of economics.
Call it anything at all. That obviously then drove mortgage rates up to quite extreme levels that are probably still too high. What that's done is basically what happens in the housing market. It was a seller's market. If you were a seller, you could get the price you wanted. You had 2 or 3 buyers. So we moved from a seller's market to a buyer's market. It's bid to offered, or offered to bid, whichever way you went, you know what I mean. But so that's typically, I would argue, that's a high single-digit percentage move. 5 to 7, 6-7% from a seller's market to a buyer's market. That's from peak. So that's what's happening now in the market. When that happens, of course, transactions dry up because you've got sellers with aspirations of they can get X, and you've got buyers there going, well, no, it's only worth Y. But then on top of that, and people like, I remember this when I bought my first flat in London, you get valuers coming in and down valuing properties, which we haven't seen for probably 20 years, maybe. Let's be honest, because we've had free money, and you never need down valued anything in free money periods. So now you've got the valuers coming in from experience in the office. I know people who are seeing that. So that's the stage we're at the moment. What would kill the housing market? So that's an adjustment. That's not going into free fall. That's an adjustment down. And then, of course, transactions will start again, and the market starts moving forward again. And with the house builders, the new house builders at the moment, of course, that impacts them because it's the same thing. The prices have gone up. New houses tend to could be at a premium to older stock, particularly now with environmental standards and everything. They get hit by that as well, and that's what we're seeing with the announcements from the likes of Persimmon and Taylor Wimpey.
Yeah, big increase in cancellation rates from what I saw.
Big cancellation rates. Yeah. They were historically a ridiculous low teens levels, 28% or something like that now.
Yeah.
I think in 2008, Persimmon peaked at 34, 35. So actually, to be fair, they've gone from 20 to 28. They're not far off the peak already, just like that. I mean, it's been a sharp shot. What the housing market, to be honest, there's only one important statistic, and that's unemployment. It will move around, but it will only crash if you get unemployment, because people will hold on to their house as long as they can. And as long as they've got a job, they will scrimp and they will save. And let's be honest, the consumer disposable income is being, it depends how you calculate it, but it could be 20% gone. But they will want to keep their house. So if you lose your job, you're then in a situation where you can't scrimp and save, you can't get another job. That's when the keys get handed back. And the last time that happened was a long time ago. That's the key. So watch unemployment. We've still got 1 million vacancies in the UK. I don't see that happening. I don't see high unemployment in the UK. So the housing market will adjust down, yes, but I don't see it will adjust down, but I don't see the market crashing. So I think the house builders are on what? Persimmon's the most expensive because it always has been, but they're on around as a group 0.7 book or something like that. So that's they're not building any more land. So on that basis, and in the short term, you're going to get downgrades. This is the stage of the cycle now where we've had the derating, and there's a really interesting statistic that if you look at the FTSE 100, all the performance has come from 20 stocks. The other 80 in the FTSE 100, which are the oils, like you said, and all that, the other 80 have performed much like the 250, so they're down high 20s, 25%, depending on where we are in the market going up and down at the moment. And the small cap and everything else, and AIM's down 30s plus and stuff like that. So we've had the derating of companies. Now, if we're going to get a downturn, we're going to get the downgrades. but markets look forward. So individual stock risk goes up, but market as a whole can kind of hover around and hopefully move better.
Yeah, and I mean the other thing I've been reading more and more, as I alluded to at the beginning of our chat, is that actually the UK as a whole is looking like is a very cheap market. You know,
totally.
I mean, pariah status squared, as you put it. But it does, and I mean, I think I read earlier there's been 17 months of outflows consecutively.
6 years, I think. I think it's 6
years. Oh, blimey! I must have got an optimist's take on that. But actually, it does seem does seem that the pace of outflows from the data I saw is starting to slow. That people are starting to look at the UK and go, okay, it's cheap enough to get back in.
Totally agree. I think it's that going back to the US CPI. If the dollar rolls over, all these global macro funds are long dollar. That's going to accentuate it. They're not going to be one. If the dollar starts to roll over, it becomes self-perpetuating. Flows move markets, which is what big adage I was taught when I was trainee fund manager. Remember, the flows move markets. So money comes out of the dollar, it's got to go somewhere. Europe, UK, even as we say, prior UK will get money. That money's got to go into assets, whether it's bonds or whether it's equities. Now, if the dollar's rolling over, you don't want to earn FTSE because FTSE is very dollar exposed. So that's why on a day like today, with the dollar down to 1.5%, you've got the FTSE up, when I last looked, 2.5%, and FTSE 100 up 0.5%. So FTSE's going up, yeah, but this should be the time for UK 250 small cap to finally come back. And it won't, let's be honest, it won't need much money to get it moving. Mm-hmm. We've had a lot of de-equitization going on, companies taken over, et cetera, et cetera, et cetera. So it shouldn't take too much to get it moving. You know, fingers crossed, that's what we will see.
Indeed. And that seems like a nice positive note to end our chat on today. FTSE 250 is up 3.8% now.
3.8 now?
3.8.
Oh my God, I'm not being at my desk. I'll be in trouble for not getting small buyers. Okay.
I better let you get back there.
That's great.
Thank you so much, Jamie. Great talking to you.
Good, thank you.